Shell PLC, ticker symbol Shell, is currently trading at $53.95 a share. Over the last year, it is up only 8%, but this stock has been on a roller coaster since the bottom of pandemic. And when I say a roller coaster, I'm talking about a roller coaster up. It is up almost 111%. Can this stock keep going higher? Can it go to its pre-pandemic levels? That is the question I'm going to be answering today. What we're going to be doing is looking at my automated stock valuation spreadsheet. It will get all of the revenue and stock information. Then we can take it to my discounted free cash flow model, my Ben Graham formula, and then the comparable company model to see if this stock is a buy or a sell. So let's go to my sheet firstly, and we will search for Shell, as I said before, ticker symbol SHEL. And what this will do is it will load the information from Google Finance and then also the income statement, balance sheet, and cash flow data, the financials here as well. So currently, as I said before, trading at $53.95 a share, market cap of 184 billion. PE ratio, which is price to earnings, is a very low 4.72, earnings per share $11.42 a share, a beta of 0.64. Now this means it's going to be less volatile than the S&P 500 overall, and has 6.9 billion shares. Now let's just go back to that dividend. The dividend information, it's a big thing on Shell, and subject to board approval, Shell aims to grow the dividend per share around 4% each year, and the group will target a distribution of its cash flow from operations of about 20 to 30%. Now, if we go back here, we can see that the dividend per share is around about $2.56, a yield of 4.75. That is very, very nice. That means that they pay out a total dividend of around 17.6 billion. Payout ratios in terms of net income, 41.69, and in terms of free cash flow, 34.91. So that's a pretty safe dividend, even with them increasing it each year. Ex-dividend date is around about the 16th of May, so buy before then if you want the shares. So if we have a look at the revenue here, this is the revenues from 2018 upwards, and you can see 388 billion, 344, pandemic year 180, and it has rebounded 267 to 381 once again. So it's actually not as high as it was in 2018, but it's had a very solid bounce back. Next, we're going to have a look at net income. Similar story again, 23.4, 15.8, negative in the pandemic year. Strong bounce back, 20 and 42. So this has actually been Shell's most profitable year, 42.3 billion. Next, we want to see what they're doing with the shares, and are they buying them back? Well, as I'm sure you guys know, Shell do reward their shareholders that way, and we can see it's gone from about 4.2 billion to 3.6. So what does that mean? Well, if there's 10 shares of a company, you own one, you would own 10% of the company. They buy back 5 shares, there are now 5 shares left, you own 20%, so you have your share of the profits. And next we have a look at the free cash flow. This is very important because obviously, as we said, we want a big free cash flow, we want them free cash flow generating and a safe dividend. And we know the dividend is safe as per the free cash flow payout ratio. 30 billion, 19.2, 17.5, 26.1, 45, and in the trailing 12 months, actually you can see 50 billion. But we're going to be looking at the 2022 value currently. So before we go to my stock valuation spreadsheet, please give a like on the video and subscribe if you're not already. Check out my Patreon if you're interested in this sheet, or also I have the more manual sheet as well, but these are very good for investors to quickly look. So we have all the financials here. We have the revenue, we have the net income, we have the free cash flow. We discount it to today's value, and that actually gives us a stock price of $37.37 a share, which does seem a tad low. But if we look at the estimated numbers, you can see the free cash flow number is very, very low. So firstly, what we'll do is have a look at the revenue growth. Well, the numbers have been all over the place, and this is -%. So I'm going to say that Shell's revenue does continue to grow. Analysts are expecting the stock to grow. So let's be very, very modest and just do a 2% growth. That puts the stock already, wow, to a 74% stock, $70 stock. Net income margins, once again, they're probably a bit on the lower side, but we'll take the average. We'll actually take the lowest number. We'll do 4.95. And then in terms of free cash flow net income, we'll take the most recent number, 108%. And that actually gives the share price at $129. Now that may seem a little bit rich, but discounted free cash flow models do value free cash flow. And obviously this stock always does generate a lot of free cash flow. So $129 stock, if we look at that, the stock has never ever been that high. The highest it was back in well, pre-financial crash, about $84 a share. So discounted free cash flow may like the stock a little bit too much. But we also do like to look at the Ben Graham formula for value investing. What does this do? Well, it estimates the value of the company over the next few years, looking at the earnings per share, the P of a no growth company, which is about 7, the expected growth rates, the AAA bond yield of corporate bonds, and then this is the average yield, and then the AAA corporate bond yield. So let's have a look at analysts. This is the only part of the sheet that is not automated. One day I will try and figure out how to automate this, but it's because Yahoo Finance doesn't let me. 3% over the next 5 years. So put 3% there, and then we will go and look at the AAA corporate bond yield, still obviously 4.56. What does this give us a value of? Well, it puts the fair value, the intrinsic value, at just shy of $109 a share, and a Graham price, which is basically, if it ever comes to this, then it's a buy and hold at 80%. So this is saying it's at a massive, massive discount, not a million miles away from what the free cash flow analysis is. Now, we said 3% over the next few years, so we'll even bring this one down again. We even say 0.75%. Discounted free cash flow still likes the stock at around about $120. So both of the models are in line. So let's finally look at the comparables model, or the comparables company analysis model, which is a process used to evaluate companies using the metrics of other businesses of similar size in the same industry. So what we will do is we will compare SHEL to companies such as Exxon, ticker symbol XOM. We'll also look at ConocoPhillips, COP, and then also another one, I'll say we'll look at Chevron, SVX. Now, as you can see, I've just typed in these tickers and the data has loaded without any problem. So what this is it looks at the equity value, which is the market cap, the debt, the enterprise value, the revenue, the EBITDA, which is earnings before interest, taxes, depreciation, and amortization, and the net income, and then it gives us these ratios here. First one, EV to revenue. What we want to do is see a lower number here. EV to EBITDA, once again, a lower number, and P lower numbers. And then we'll take the averages, and then this will spit out some numbers here. So firstly, if we have a look at SHEL, 0.7, 2.7, 4.8. Lowest EV to revenue number, lowest EV to EBITDA, and lowest P ratio. So I think that, as we can see here, the stock will be liked by this. The averages of these numbers, 4.3. And this will give us the enterprise value based on this metric, and then this will give us an implied market value. So if the stock is currently about $53.95, based on these estimates here, $126 a share in terms of EV to revenue. EV to EBITDA, I don't know why that's red, I'll change that to be green, but $93 a share. And then finally 81.19. So overall, if we take the averages of these, this brings it at about $100 stock. Now these, I am pretty happy with estimates. The only one I think is a little bit different is the Exxon. So if we have a look at SHEL comparable company compare, another one we could also look at, which would be BP as well, ticker symbol BP. We'll have a look at them. Now, you can see here that BP don't have a PE ratio, so it does mess up these numbers, but then that does give us $109 and $101 because this company is a lot closer in terms of equity value compared to Chevron. So $109 stock if that way, or if we look at Exxon, $100 based on that. So the comparables model says it's a buy, the Graham model says it's a buy, discounted free cash flow model also says it's a buy, and the stock pays a lovely 4.75% dividend. Right guys, thanks for watching. Please give a like on the video if you enjoyed it. There was a cut in here, let's see if you can notice when it was. Subscribe if you're not already, and check out my Patreon. Links are in the description down below, and I'll catch you guys next time.